Okay, let's unpack this. Today, we're embarking on a deep dive into the latest financial results of Go Digit General Insurance Limited. We're looking at the first quarter of fiscal year 2026, so the period ending June 30th, 2025. And to navigate this, we've stacked up quite a bit of source material. There are unaudited financials, official press releases, investor presentations, even the full earnings call transcript. Our mission really is to cut through the numbers, the jargon, pull out the most important insights, and maybe deliver some surprising facts that help you understand what's truly shaping this key player in the Indian insurance sector right now.
Absolutely. And what's fascinating here is how these results, they don't just tell a story about GoDigit's own performance, but they also give us a window, really, into the broader trends and some unique challenges facing the general insurance industry as a whole.
Okay, so let's jump straight into the headlines then. What were the standout figures for GoDigit in Q1 FY26? We saw gross written premium, GWP they call it, climb to 2,982 crore. That's up from 2,660 crore last year. So pretty robust 12.1% growth.
Yeah, that's a solid start.
And then profit before tax, PBT, that soared by 59.4% to 161 crore from 101 crore.
Almost 60%. Wow.
Right. And profit after tax, PAT, increased a healthy 36.6%, reaching 138 crore from over to 1 crore. Oh, and their assets under management, AUM, grew 17.4% to hit over 20,861 crore as of June 30th.
Now, it's crucial to pause on that PAT figure for a second. This is actually the first time GoDigit's PAT and PBT have been different.
Oh, interesting. Why is that?
Well, it signals a shift. The company anticipates starting to pay current tax this year. It's kind of a strategic move to account for accumulated losses they've had in the past. For the full year, they're projecting an expected tax rate of, I think, 13.9%.
Okay, that is a significant change. So bringing it all together, what do these numbers, especially for profitability, really signify for the company? We also saw their return on average equity, ROE, on a PAT basis tick up just slightly to 3.4% this quarter. That was 3.3% last year, though, these aren't annualized figures.
Right, important caveat.
And their net worth jumped substantially. I mean, it rose from around 2,100 crore last year to 4,100 crore this year. That's a 33% increase.
Yeah, and that 33% jump in net worth, it's more than just a big number. It really strengthens their financial backbone, doesn't it? For an insurance company, having a larger net worth gives you a much more substantial buffer against unexpected losses.
Right, cushions the blows.
Exactly. And that resilience could let them underwrite more policies, absorb bigger risks, maybe even weather market volatility better. It potentially sets them up for, let's say, more aggressive but still secure growth ahead. It really indicates a healthier, more robust financial foundation.
Okay, so we've seen the big picture. The headlines look pretty good. But to truly understand GoDigit's engine, we need to peel back the layers a bit on revenue and profitability. What do these gross written premium and net premium earned figures really reveal about their operational strengths and maybe some challenges this quarter? The GWP, like we said, of 2,982 crore. Now, the company pointed out something interesting. If you adjust for a new accounting basis, they call it the 1N basis, which kicked in October 2024, for long-term products, their GWP would actually have been higher, 3,046 crore. That would show an even stronger 14.5% growth. So this accounting change itself, it reduced the reported GWP by about 64.5 crore.
Right, and it's key to understand that's just about when they recognize the revenue. It's an accounting timing thing.
Exactly. It didn't hit their actual cash flow or the bottom line, which is why, as they noted, it had zero impact on PT. Net premium earned also saw a slight increase, up to 1,865 crore from 1,824 crore. However, there's a critical point here. Underwriting actually suffered a loss, 193.58 crore. And that loss is bigger than last year's 170.16 crore loss. But on the flip side, investment income, net, that increased significantly. It hit 314.07 crore, up from 253.19 crore last year.
That's a sharp observation, and it brings up a key puzzle, doesn't it? How does GoDigit manage to stay so profitable, even reporting these increased profits, despite facing, consistent underwriting losses?
Yeah, where's the magic coming from?
Well, the engine, without a doubt, is that significant surge in investment income. It's largely driven by their expanding assets under management base, which, as you mentioned, has grown to nearly 21,000 crore. The yield on those investments for the quarter, if you exclude unrealized gains, was 1.8%. Plus, they had a capital gain of about 10.2 crore.
Okay.
Now, while this investment performance is obviously crucial to their overall profitability right now, it does raise that question of long-term sustainability. I mean, for an insurance company, strong, consistent underwriting profitability is often seen as the hallmark of true operational efficiency.
Right, making money from the core business.
Exactly. Relying heavily on investment income, well, it can sometimes be sort of a double-edged sword. It makes your overall profits potentially more susceptible to market fluctuations.
That's a really insightful point, that balance between underwriting and investment income. Speaking of financial health, though, I'm particularly interested in their balance sheet strength.
Yeah.
How robust is GoDigit's financial foundation looking? Their solvency ratio stood impressively at 2.27 times as of June 30th,
Yeah, that's strong.
comfortably above the minimum regulatory requirement, which is 1.50x, and it's actually up from 2.17x in Q1 last year. And their total assets were reported at a pretty substantial IDO 20,676.93 core.
So, yeah, fundamentally sound on that front.
Definitely looks solid. But let's pivot to another crucial indicator, maybe one that links back to that underwriting loss, the combined ratio. This metric tells us if an insurer is making money from its core business before considering investment income, right? And anything over 100% means an underwriting loss.
That's the one.
GoDigit reported a combined ratio of 108.6% for Q1 FY26. Now that's up from 105.4% in Q1 last year. So the underwriting loss as a percentage got worse. The expense ratio also increased to 38.3% from 34.9%, but the incurred claim ratio actually slightly improved down to 70.3% from 70.5%. So what does it all mean? The loss ratio got slightly better, but the combined ratio still went up. That seems counterintuitive.
It absolutely does seem counterintuitive at first glance. But if we connect this to the bigger picture, the key really lies in the net retention ratio. That ratio reduced significantly this quarter. It dropped to 65.4% from 76.2% last year.
Okay, so what does that mean in simple terms?
It essentially means the company is ceding or passing off a much larger portion of its premium to reinsurers. They're keeping less of the risk and less of the premium themselves. Now, management gave two main reasons for this strategic shift. First, it was a deliberate decision to increase the cession, especially in their fire business. They've apparently gained some significant large corporate accounts there. And despite seeing huge growth in fire, 40%, versus the industry's 17%, they actually chose to reinsure more to diversify their risk.
Oh.
Proactive risk management.
Exactly. And maybe particularly prudent given that the industry apparently saw a massive Euro 2,000 crore fire loss in Q1, which GoDigit wasn't part of. So this is a deliberate move, they say, to protect their overall reinsurance treaty.
Okay, that's one reason. What was the second?
The second is strong growth in what they call 1+5 new two-wheeler policies. These are policies covering 1 year of own damage and 5 years of third-party liability. Now, with these, the premium is technically earned for only the first year in the books, but the commission for all 5 years gets expensed upfront.
Ah, okay, I see. An accounting mismatch again. Precisely. It creates this sort of optical effect, lowering the net retention ratio on paper and consequently pushing up the combined ratio. And this two-wheeler segment, it now makes up 31% of their motor business. Management thinks that might be the highest percentage in the industry for this specific segment.
Wow, 31% two-wheeler is significant. So management's perspective is that this lower retention is just a one-quarter impact, making the combined ratio look worse optically, but not actually hurting profitability.
That's their line, yes. They even calculated that if retention in fire, marine, engineering, and liability had stayed at last year's 15% level instead of dropping to 9%, the combined ratio, excluding that one accounting change, would have been 105.2%, which would have been an improvement over last year.
Right, but from an external perspective, maybe for you listening, how confident can we be that this truly is just a one-quarter impact?
Yeah.
What specific indicators should you look for in future quarters to confirm this theory, or what could cause this lower retention to actually linger?
That's a very fair challenge. I think the key indicators to watch will be, first, does that net retention ratio start to normalize? Does it creep back up towards previous levels? Especially as those 1+5 foot two-wheeler policies mature beyond that initial commission recognition period? That should naturally help. Also, you'd want to monitor the growth and stability of their commercial lines, particularly fire and engineering. Does that strategic session level stay consistent or does it increase further?
Okay.
Because, a persistent lower retention quarter after quarter might signal something more fundamental is changing, maybe a shift in their risk appetite or their long-term reinsurance strategy, rather than just being a temporary optical effect.
Got it. So keep an eye on that net retention ratio and the commercial line session. All right, let's zoom in now. If the overall picture is one of, let's say, an optimizing portfolio, where specifically are they seeing explosive growth and where are the real headwinds testing their strategy? I'm particularly curious about how their motor mix compares to the broader industry. Let's start with motor insurance, since it's their largest segment. Okay, overall GWP growth was 5.4% for motor-owned damage, or OD, but a stronger 21.2% for motor third-party, or TP. Interestingly, the motor OD loss ratio actually increased to 69.3% from 64.1%, while motor TP stayed pretty steady at 66.0%.
OD claims creeping up.
Yeah. And GoDigit's overall motor mix is 37% OD and 63% TP. That differs a bit from the industry average, which is more like 41% QD, 59% TP. Their overall motor portfolio mix is about 41% private car, 31% two-wheeler, as we just discussed, and 28% commercial vehicles.
Right.
Now, moving to the health, travel, and personal accident segment. Here we saw a pretty significant GWP decline of 12.9% for the quarter.
A decline. Okay.
Yeah. Though interestingly, its loss ratio actually improved, down to 83.3% from 85.6%. Management explained this decline is primarily due to volatility in the employer-employee group health segment. Apparently, some aggressive private companies are pulling back, degrowing in that space right now. It's important to note, GoDigit's retail health part is less than 10% of their business. They claim they're still among the best in class for combined health loss ratios, looking across both retail and group.
So a strategic pullback, perhaps, or just market dynamics in group health?
Seems like it. Then fire insurance was a definite standout. GWP growth of 40.7%, smashing the industry's 17.1%, and its share of their total GWP mix increased to 19.7%. This rapid growth, particularly in those large corporate accounts, was, as we discussed, a key reason for that strategic reinsurance session.
Right, linking back to the retention ratio.
Exactly. And lastly, the miscellaneous and others category. This bundles things like marine and liability that saw strong growth too, up 23.2%. So commercial lines in general, including fire, engineering projects like power, and liability covers like D&O, cyber, public liability, they all seem to be performing quite well.
Which brings up that important strategic question again. How does the company plan to navigate pricing pressures, especially in such a competitive market like motor or even group health?
Yeah, what's the plan there?
Well, management has stated they're continuously quoting for business, obviously. They anticipate seeing accelerated growth when, or maybe if, market conditions turn and their conversion ratios improve. They seem to hold a belief, maybe a hope, that companies which were overly aggressive, particularly in motor TP pricing between, say, 2021 and 2023, will eventually face significant loss development. The claims catch up. And that could lead to some much-needed pricing discipline emerging across the industry. Maybe in the next 12 to 18 months, it sounds like they're playing a bit of a long game there.
Waiting for the market to rationalize. That's a fascinating look at their segments. Now let's pivot slightly to operational efficiencies and the broader regulatory environment. There's a critical point here. The company mentioned its expenses related to the insurance business are currently in excess of the IRDAI regulatory, limits the expenses of management regulations from 2024. That's for Q1 FY26.
The expense ratio caps. Yeah, that's a hot topic for many insurers.
Right. And GoDigit has submitted information to IRDAI seeking forbearance, basically asking for some leeway for the full financial year FY25. Now, this isn't just a technicality, is it? It feels like a key regulatory challenge that could impact their ability to grow or operate freely if it's not resolved favorably. How might this play out?
That's indeed a significant area to watch. This whole issue with the IRDAI regulations on expenses, it's a recurring theme for, well, many insurers who are trying to grow in this market with evolving rules. It really highlights that delicate balance between driving growth, investing in tech maybe, and staying compliant. The fact that GoDigit's absolute non-commission operating expenses actually declined by 10% year on year despite this regulatory pressure suggests they are actively working on cost optimization.
Okay, so they are trying to control costs internally.
It seems so. They believe their management expenses are, quote, industry best and can still be optimized further, especially, they argue, when premium rates eventually increase, because these operational expenses aren't directly tied one-to-one with the premium price itself. So it signals a commitment to efficiency even while they're navigating this current regulatory excess situation.
Okay. And speaking of external factors, there was also a note that the company voluntarily deposited some tax and interest related to a DGGI summons. They recognized about an 83 lakh penalty in Q1 for this, and they're currently awaiting a closure order.
Right, another compliance point to track.
Also worth noting, just as a point of internal change, Mr. Atul Mithra, who is country head for retail geographies and key partnerships, as senior management personnel, he resigned, effective August 11, 2025, citing personal considerations. And as always, the crucial reminder for everyone listening, seasonality affects these quarterly results. They aren't necessarily indicative of how the full year will shape up.
Absolute critical point.
Let's shift gears then to their investment book. We know investment income is key to their profits right now. So how is GoDigit strategically managing these assets to drive shareholder value? Their assets under management, AUM, have grown substantially, up by about 3,100 crore over the last year, now standing at that robust 3,861 crore figure.
That's a lot of assets generating income.
It is. And their core investment philosophy, they say, aims to gradually increase their equity allocation up to 10% of the total asset allocation. But while the AUM has grown, their equity allocation has actually remained fairly stable recently. It was 6.3, 6.4% in this quarter, Q1 FY26. That's similar to March 2025, though up from maybe 3.5% back in December 2024. The company views equity kind of poetically as the cherry on the cake, not the cake itself. They're aiming for consistent returns on equity from the broader, less volatile portfolio.
And what's particularly insightful there, I think, is their nuanced approach to balancing risk and return. It's not just about chasing the highest possible yield. Going much beyond that 10% equity allocation, as they've explained it, would actually demand significantly more capital held back just to absorb potential volatility.
Right, capital adequacy rules.
Exactly, and that would directly impact their return on equity, the ROE metric. So this isn't just about maximizing investment income in isolation. It seems to be about preserving flexibility, maintaining robust reinsurance treaty capacity, which, as we discussed, can be far more valuable in the long run than just squeezing out a bit more reinsurance commission today. It really speaks to a more conservative, maybe long-term approach to capital management, prioritizing stability and strategic maneuverability over perhaps more aggressive but potentially volatile returns.
Interesting perspective. And finally, just for shareholders listening, the public shareholding stood at 26.9% in Q1 FY26. And on a positive note, there were no investor complaints pending at the end of the period. They received one during the quarter, and it was disposed of.
Good housekeeping.
So after all that, what's the big takeaway for you? We've delved pretty deep into GoDigit General Insurance's Q1 FY26 results, hopefully moving beyond just the raw numbers. To understand the strategic decisions behind their strong top-line growth, those significant profit jumps, and their quite nuanced approach to reinsurance and focusing on specific segments. The picture that emerges, I think, is of a dynamic company, one that's actively navigating industry shifts, trying to optimize its portfolio for long-term value, even while juggling these regulatory complexities like the expense ratio limits.
Yeah, I agree. And this leaves us with perhaps an important question for you, the listener, to consider. In an insurance industry that's facing both evolving regulatory scrutiny, particularly on expenses, and these intense market-driven pricing pressures we talked about, how essential is a nimble, digitally driven strategy like the one GoDigit champions for securing not just sustained profitability, but maybe truly disruptive growth in the years ahead?
That's definitely a thought worth exploring further as you watch the insurance landscape continue to evolve. Thank you for joining us on this deep dive into the numbers and the strategies shaping the future of insurance.